rare occasions I've had two. Anyway, today we're going to start the topic, and this should only take one lecture, so we should actually get right through this thing today. Non-bank financial institutions. By far the largest financial institutions in our system are the commercial banks. But these are a group of institutions which do some of the same things that the commercial banks do. Often they have a restricted range of services that they provide, and they're significantly smaller, but they do actually provide some services that the banks themselves don't provide in one way or another. So we'll just talk briefly about where some of them came from, and then we'll talk about the three different types that we'll be looking at in this section: the building societies, the credit unions, and the finance companies. So where on earth do these things come from? Well, there's sort of several groups in there, but if you take the building society and the credit unions in particular, they're part of a group of institutions we tend to call thrift institutions, and that word thrift is sort of a word that's sort of almost gone completely out of the use of the English language. You don't hear it much anymore, but it basically means about people saving and trying to invest and grow their money they've got. So there were several different types of organizations set up. And one of the reasons they did this is that the commercial banks, one of the reasons commercial banks are called commercial banks is that because initially, way back when, they actually only dealt with businesses. So they, like, if you walked in off the street as an individual and you wanted to open an account at a bank, typically you couldn't do that. And so these other types of institutions were developed, came into existence to deal with the fact that small private individuals they wanted to save as well, and they wanted to invest as well. And so there were several types set up. First one, the mutual savings banks, was developed in the 1800s, so it's probably more than 2 centuries ago now. And they simply were for people to deposit their money, and initially they could do pretty much anything they liked in terms of investment. So once you deposited your money with them, they would then go away and invest in pretty much anything they liked. Over time, there was good reason for this, but over time they became specialized in mortgage loans. The other one, again, this is both of these are savings banks and this mutual savings and loans. They tend to be initially U.S. organizations, and we didn't see many of them out here. The Savings and Loans Association was set up by people so they could pool their savings and then make loans to people who are members of the association, and they could buy a house. So that's their reason for existence. And that's very similar in some senses to the building societies, which we tended to see in this part of the world. The very first building society, as you can see there, the date 1775, and it was for people to pool their savings, make loans to each other so they could buy a house. Now, a lot of things have changed in structure over time, particularly these savings and loans associations and savings banks, is that initially they were mutuals. That means that they were owned by the depositors. And basically you ask the question, how much of this bank do I own? Basically, whatever your proportion of the total deposits were yours, that was the proportion of the bank that you owned. Now, in that sort of situation, typically what happened is that the people who are depositing money don't have a lot of financial expertise, so they would, meet, vote, put trustees in place who would employ managers who would actually then go about the actual business of running the bank. Initially, they could pretty much invest in anything, whether they're loans, stocks, bonds, anything else that they thought they could make a good return on, they could go out and do that. But one of the things that happened in the U.S., not so much here, is that initially there was two types. There was these savings banks, and then there was a Savings and Loans Association. And the U.S. government put significant tax credits in place for them to specialize in mortgage loans. So once you have an incentive to do that, a lot of these institutions responded. And so essentially the savings bank and the Savings and Loans Associations converged to a single type of institution specializing in making mortgage loans. And in this part of the world, we tended to see building societies which function pretty much in the same way and do the same sort of thing. So that's just a bit of background. So what are the types of non-bank financial institutions we have here? What are our, just went roaring past a few minutes ago. What were they? An insurance company wasn't one of them, no. Building society is one, yes. Credit union is another. Finance companies. So those are the three that we're going to look at. They're actually very small, and we'll give some details a little about how small they are. But the question is, if they're so small, and they are as a group, if you take every last one of them put together, they're not even as big as one of the main banks. Why are they important to the financial system? Why do we have these things? Why do we still have them when, you know, most of the things that they do, in one sense, the banks could do as well? Why are they still going? Why haven't they gone out of business? Ooh, everybody's quiet. One of the main things with these things is when you start looking at what they do, often you'll find that they're making higher risk loans than a bank would. So if you think, like, for example, a finance company is a good example, is often, when you look at the types of loans they make, they're high risk. And so if you think of what a bank does, banks tend to be, you know, prudentially regulated, and so they don't take a lot of risk with the loans they make. And so you can get situations where the project itself is probably worth financing, but the risk is sufficiently high that the bank won't go ahead and do it. Like, for example, one I actually know, guy in the Marlborough Sounds I knew was a fisherman, wanted to get a better fishing boat. And he went around all the banks, and they all said, no way, this is simply too high risk for us. Basically, that's right. They put it that way, but that's the basic problem, is that financing the guy into a new fishing boat was too risky. And so the next port of call then would be a finance company, and because they tend to specialize in higher risk lending, he was able to find finance from a finance company, which of course, you know, it costs him more as well because the risk is higher. And so they often fit into this area that they do essentially what a bank does, you know, bring in money, make loans, but they tend to be making loans in the high risk area of the market. So there's the three of them. Now this is pretty old data now. You know, this is Australian data here, 224 billion in assets. That's every last one of them put together. And remember, only a few lectures ago when I put up the size of the Australian banks, some of those Australian banks are now approaching to be, you know, trillion-dollar banks. So they're typically, you know, even if you put the whole lot together, they're nowhere near being the same size as a bank. When that number was collected, it was about half the size of one of the big four pillars. So you put every last credit union, building society, and finance company together, about half the size of one of those major banks. So they're quite small, but because they make this high-risk lending that otherwise would be very difficult for people to get finance for, they actually form quite a useful function in the financial system. So here's some data about them, and some of this is quite interesting. If you look at, you know, this period here, this is your dates here. There's a period of about 22 years. The banks themselves, so this is the banks collectively, this is the assets they've had, and they've grown by a factor somewhere around 8 to 9 over that 22-year period. If you look at the building societies, they've actually went through a period of contraction to there, and then they've had some very slow growth to there, and they're even, you know, 22 years later, they're smaller than they started. So building societies are not doing well. Credit unions, that's this pile here. I mean, they have grown, but that's probably at most about a factor of 6. And finance companies, again, they have grown, but that's less than a factor of 3. So although they perform a useful function within the financial sector, their growth, where it has occurred, certainly it hasn't occurred in the building society, has been slower than that of the major banks. And it's fair to say that the major banks themselves are actually doing more of the high-risk lending. Okay, it's still not a high proportion of their business, but then if you can go to your bank and get a loan, most people would prefer to do that than to go to one of these other institutions. So, building societies. What are the main characteristics, and particularly what makes them different from a bank? Yeah, they're a lot smaller, yes. They are definitely a lot smaller. Yeah, go ahead. Okay, so they're highly concentrated both in the type of loans they make, like very strongly in the mortgage market, and also geographically concentrated as well. Yeah, and so that puts their risk up. And if you look at the credit rating on, I think, Nelson Building Society, they've got a double B rating, which means, junk bond stuff. And that's simply high risk. Now, one thing about them, it's actually kind of surprising now how many there actually were. At their peak, there was 72 building societies in New Zealand. The vast majority of them have gone out of existence one way or another. Okay, so income. How do they make their money? Okay, and so that's a difference between what they're paying depositors versus what they're getting on their loans. Most of the money comes from net interest income. I think I've got a slide here about that. Let me just check over and see if I've got it there. Oh, no, it's farther away than I thought it was. Okay. Well, we always said about their assets, mainly their mortgages. What about sources of capital? Where would they get their sources of capital, considering that these things are mutuals, they're not listed on a stock exchange, and so they can't go out to the capital markets and raise money by issuing more shares? Yeah, go ahead. Yeah, retained earnings is basically how they grow them. And this is one of the reasons why, when you look at particularly overseas equivalents, one of the reasons that they have converted from being mutuals to being stock ownership is that it gives them greater access to capital. So these things tend to be quite restricted in how fast they can grow, because the only way to raise more capital is to retain earnings. So their ability to grow is quite limited. So they are changing over time. Any particular responses to changes in regulations that you know about? Oops, okay. So let's go here to see if Mr. Dutch. One thing we should say about the regulation, if you look at the difference between New Zealand and Australia, in Australia, they were back under the Reserve Bank of Australia since '59. That originally was the Prudential Regulator. So they were under Prudential regulation since 1959, and they got split off from the Reserve Bank into APRA in 1998. Now in New Zealand, they have only had prudential supervision since 2007. So for a long time, they were basically left to do their own thing. And there's not many of them left now, but this fact that they didn't have prudential regulation really was a big issue for our finance companies. Not so much for the building societies, but for the finance companies was quite a big deal. Still a few left. Southland Building Society is actually a registered bank, and it's still a mutual. But the vast majority of them, when you think that we had 72 at one stage, they've gone out of business one way or another. Either they've been merged into something else, or they've restructured themselves in some way and become another type of financial institution. So there's very few left of these things. Now, if you look at Southland Building Society and you think what it does now, because deregulation has opened up new lines of business for them, KiwiSavers, insurance, consumer loans, financial advice, unit trust, and so on. They've actually branched out into pretty much a full services financial institution. So they're not that much different now to a bank. They offer a wide range of services. But if you look at the structure of their balance sheet, even now, the bulk of their assets are in mortgages. And these other ones, although they're moving into them and they are growing, it's going to take a long time for them to diversify away from their core business of making mortgage loans. So I said that about it's changing slowly. Profits are accumulated, said that bit. Yep, said that bit down there as well, so let's move on. Now, this is what I was thinking of. When you look at this, you have there's your interest revenue coming in, there's your interest expense. They don't actually give a net interest income, but the other thing they have here is the non-interest income. And just like we saw with the major banks, if you look at the difference between the net, say the net interest income, say between those two is about, say, $16 million there, versus non-interest income, which is about $3 million. So, yeah, 2.3 million. The vast majority of their income comes from traditional intermediated finance. So they have money come in from deposits, and they're making loans, and they're making money on the differential between those two things, and that's still their main line of business. And so although non-interest income is growing in importance, it is still very small or relatively minor compared to the traditional intermediated finance that they do. So the future for them is uncertain. There's not many left, and even the ones that are left tend to be changing their structure. One of the reasons that so many have gone out of existence is that the way the population is distributed across the country has changed, and it continues to change. Many of the building societies, when you look at where they were in regions outside the main metropolitan centers. And as people have tended to move away from this into the cities, then the need for building societies has gradually disappeared in those areas. The other thing that they have problems with is technology. If you're small, have a small staff, and sometimes you can't pay enough to attract really good staff. Implementing new technology, particularly in the banking sector, can be quite difficult for you. Okay, any question on that before we go to credit unions? Yeah, got a question?
From your slides, you said that the South Island Building Society is still mutual. What's that?
Southland Building Society as a mutual, that means that the depositors own the bank. So whatever proportion of the total deposits is deposits that you put in, that is your proportion of the ownership in the bank. And so you cannot buy shares in the Southland Building Society on the share market. If you want to become an owner, you have to become a depositor. So the depositors are the owners of the bank. That's what a mutual is.
So since if you deposit, you own part of the partnership, doesn't mean that you share the profit as well if you deposit money?
It depends a little bit how they structure it. What they tend to do is profits that not intending to retain tend to be paid out as interest. Well, the way it looks to you is paid out as interest. So, if they have a profit, some of it they will retain to grow, and the other batch of profits that they do not intend to retain, like a normal company, you would think, well, that'd be paid out as a dividend. What actually happens, it gets paid to you essentially as what looks like an interest payment into your account. Did you? Yeah, I mean that's one of the arguments that they make. If you go and look at their website, that their interest rates are higher than bank. But when you think about like Nelson Building Society, I think it's got a double B rating. You definitely want a higher interest rate anyway because the risk is higher. Yeah. Any other questions? Yep, go ahead. What's that? Other income. Well, like for example, if you think what the Southland Building Society does, it doesn't have its own unit trust, so it will sell unit trusts on behalf of someone else. They'll get fee income for that. They provide financial advice, and sometimes they'll charge for that. So the other income is basically primarily fee income for services provided. Okay. Any other questions? Right. Okay, so credit unions, on to credit unions. So I changed this a little bit. What needs do credit unions fulfill? Why do we have credit unions? Why do we have credit unions? They still exist. And not only do they still exist, they're actually growing. Oops, oh, very quiet. Credit unions, they specialize in making small loans to consumers. In terms of the regulation, credit unions are authorized deposit-taking institutions in Australia, so that means they've had prudential regulations since 1959. Whereas again, in New Zealand, there was this comprehensive law that went through in 2007, and they've only come under prudential supervision since then. So the way they work, they're mutuals, again, so the depositors here own the credit union. And you have shares, you vote to get a board, and then the board essentially manages it. Now, the thing about them, in terms, to become one, there's supposed to be this common bond requirement. And it used to be that the common bond requirement was quite strict. Like, for example, there still is a Fisher & Paykel credit union. And it used to be in the old days, the only way to become a member of the Fisher & Paykel credit union was actually to work for Fisher & Paykel. There was no other way to become a member. And so what you would have is a bunch of people with some sort of common bond, you know, whether it was where you worked, where you lived, a church you went to, whatever it is, there was some common bond that you had to have before you're actually allowed to join one of these things. And it's fair to say that the common bond requirement has been relaxed over time. And for example, in New Zealand we have a series of things called New Zealand credit unions, and for example, there's one called Credit Union South, which is for the South Island, and the common bond in that case is you live in the South Island. That's the only requirement to be able to join. Now, there's not a lot of people, you know, about 1 in 20 people in New Zealand actually belong to one, so there's not lots of them here, but even so, I think we've got something in the order of 20-something credit unions in New Zealand. And again, you know, some people find them worth joining. In New Zealand, you know, they're definitely not a registered bank, although some of them talk about the banking services. If you look at them in terms of their structure, this is an average across them. I can't remember where I got this number, but I haven't been able to find a better one. The average capital adequacy ratio is 17.3% for the credit union. If that was a bank, this would be like Superman Bank. It'd be really strong. But in actual fact, these things, because of they're small, they're highly concentrated, and they're both in geographical area and in type of loan that they make, they tend to have quite low credit ratings. And I think I've got one over here. Yeah. New Zealand Credit Union South, again, BB. So although it has a lot of capital in one sense, because of the concentration, both geographically and in the type of loans they make, they are not considered to be strong. And so BB rating definitely down in the junk bond. Now, a group of these, the New Zealand credit unions, there's several of those, and they've linked themselves together to form something that looks a bit like a bank structure. And so you can actually, if you're out of the South Island and you bank with the New Zealand Credit Union South, and you're in the North Island, they've got ways for you to draw money out at one of their associates up there. Said most of that. Another key thing about them, because they're mutual, they're often not for profit. And so what you often find is because they're non-profit organizations that they're actually tax exempt. And so that's one of the reasons why, if you think, why are the interest rates higher at these things than somewhere else? Often they pay no tax, and so that's a good idea. And where they make their loans, they tend to make quite small consumer loans. So if you want to, buy a new TV, and your bank says no, can't have a new TV, and you belong to a credit union, you can often get a loan of that type from them. Okay. What are the most important assets and liabilities? Oh, me. All very quiet today. Nobody going to say anything? Oops. Oh, well. Okay. You're on. Kind of obvious. Their assets are the loans they make to their members. So they don't, in general, don't make loans outside. Like anything else, they face a problem of liquidity, and so they hold cash and investments to maintain liquidity as necessary. Now, this is Australian stuff, and there's a few curious pieces in here that are worth pointing out. If you think about the loans that they're making, that's that line there, and we've got a 7-year period. They went from about $1.6 billion up to about $7.8 billion in loans. So there's big growth in loans. Now I think, where does that money come from? If you look at their deposits, this is this line here, that's gone from about 1.5 billion up to just about 6 billion. So that's grown by a factor of about 4. But the thing that's really grown is this line here, the borrowings. And initially, at this point here, 2005, borrowings, which is basically money market type securities of various sorts, or short-term loans from other places, was about 1/10 of the deposits. But by the time you get to 2012, you're up to about $2.2 billion there, and that's almost a third. So it's gone from about 1/10 of the size of the deposit through to about 1/3 of the size of the deposit. So what has happened with these things is the demand for the loans has grown strongly, and although they have taken in more deposits, what they have found is that the deposits coming in have not kept up with the loan demand, and so they've gone to other sources of funds to make the loans. And so that's where a big growth in terms of other borrowings that they've had, which is a change in in the way that they've done things, because if you go back far enough, they did not borrow outside at all. They were totally reliant on members' deposits to make these loans. So in terms of where they're going, tend to be merging, liquidating, in some cases. Where they are able to, they are adopting new technologies, particularly internet technologies, to go about the business. And they do have, like this one here, New Zealand Association of Credit Unions, which is there to lobby government on their behalf for favorable conditions. Okay, any questions on credit unions before we go to finance companies? Yep, go ahead.
Where do they borrow from?
Well, pretty much you can go into any market. I mean, for example, you could borrow from another bank. You can issue things like debentures out into the retail market. Sometimes they can issue a long-term bond or something like that. So basically, they can't issue shares, obviously, but anything else, most of them don't have a high enough credit rating to actually issue money market securities. But there's other sources of places where they can borrow from.
So you're saying that the building society, they can't issue bonds and issue any securities in the money market, but credit union can?
No, credit union probably can't, because for exactly the same reason, is that, like, if you look at Credit Union South, which is one of the big ones in New Zealand, it only has a BB rating, and so that's firmly down your junk bond area, and they would not be able to raise money through a money market. They wouldn't issue commercial paper. They just wouldn't be able. No one would take it up, so they wouldn't be able to do that.
So, if you said that they are really, the credit rating for them is really, really low, so if they borrow from the bank, then the bank definitely going to charge them more.
Yeah.
Than the credit rating.
Yeah.
So, if they borrow to make the loans, then the loans, also that they have to balance out, the market, even though they are not profit, but I assume the loan they made is really expensive.
Yeah, with that structural change, I haven't actually looked exactly what's happened with these things, but with that structural change, I would imagine their cost of funds have gone up, which means their loan rates also have to correspondingly go up. But do remember that they're non-profit, so they're not paying tax, and so that's going to give them a significant advantage in terms of their loan rates as well. Oh, for the common bond, it's only a requirement. There's no fee associated. Like, for example, if you work for Fisher Paykel, you don't have to. used to be, that was a requirement. There was no requirement to join, but if you wanted to join the Fisher and Paykel Credit Union, then you had to work there. And then, like New Zealand, what do you call it, is Canterbury Emergency Services Credit Union. You had to work in the emergency services to join, and so there's no special fee to join, but like you had to be like an ambulance driver or a fire crew, something like that, to actually join. Okay.
And can you borrow from the credit union?
With the deregulation, yes, they are doing more of that. But they're still, the vast majority is to their own members. Yeah, go ahead.
Some of the relaxation of membership, wouldn't that kind of dilute their argument for being
Yeah. I mean, some of it, like you live in the South Island, that's your common bond. It's pretty weak. Yeah, it's pretty weak.
I was about to say, what is the strong justification for being tax-free? Because essentially, it is still operating on a profit basis for the members. It's not like, oh, whoop-de-doo, let's go give our money to people for free and not get a profit.
Yeah, it's probably one of those situations where there was historical justification for this, but the lawmakers and the regulators haven't really caught up with the changes properly. And some of the justification for being tax exempt has probably actually gone away, but law hasn't caught up with them. So party while you can.
So, is the advantage from being tax exempt, is it quite substantial?
Oh yeah.
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 If you have access to
Yeah, I mean, it is restricted. Tend to be restricted to small loans. But if you need a loan and you could become a member of a credit union, they're certainly worthwhile. And I've seen articles advocating that people should be in a credit union rather than a bank. But I've seen those articles rather unbalanced, in my opinion. But certainly, if you need the type of finance they provide, they're certainly worth being in one. Okay. So moving on to finance companies. Now, in New Zealand, they've got the rather checkered record, and I just thought I'd show you how many of these things went under, because there's this, we had this bad patch where a vast majority of them that we had, over 2/3 of that we had, finance companies actually went under. So what I've done, this is a list of all the ones that's failed since 2006. In fact, here's a good joke up here. First ranking secured debentures, that's what they used to call the things they issued out. Yeah, right, whatever. Anyway, so here's a list of ones that have failed since 2006. Now, put this line in here because August 2007 was where people tend to date the start of the financial crisis from. And we can see there's a great pile of them. And we flip the page, and there's, there's lots and lots and lots and lots, and there's sort of basically the end of the crisis period there. And we keep on going, keep on going, keep on going. And there were 67 finance company failures, or there have been 67 finance company failures in New Zealand since 2006. And if you look at what's here, receivership, moratorium suspended, receivership, blah, 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 statutory amendment, the whole lot. And so when we talk about making high-risk loans, which they are doing, that's quite real. And a lot of these things failed. The other interesting column in here is expected recovery in percent, like this one. Let's go here, top one here. National Finance, they expected to make a 48% recovery of the funds. Next one down was quite good, 92%. And 82, there's another one under 50. There's one at 10% expected recovery. There's a 0. Oh, that's bad. And so, we talk about default. The next thing after default is try to recover your money. And the receivership, when you bring in a receiver, that's basically his big job, is try to recover funds from, the loan book they have. And some cases, like this one here, 92.2%, that's not too bad. Recovery after default. But 0%, sometimes you lose everything. So, 67 all up since 2006, and the last one was actually in 2012. So since then, we've basically weeded out all the rubbish, and the ones we do have left, hopefully they've learned their lesson, and they're better than they used to be. Anyway, on we go. So what role do these people play in the finance system, in the economy? Yep.
I was just going to ask before,
Oh, yeah.
there's a lot of recurring names of key people.
Oh, yes, there were.
Category for finance companies such as your Alan Humberts and your and that type of stuff.
Yep.
What I was going to, yeah, so like how much does that really affect like the, what you say, the validity of the finance company? And like what do the people do to get into those states? Because like obviously it's not like there's a widespread error across a lot of people and it can fail, but in essence it was more that a couple of people repeated the same.
Yeah. When you're making high-risk loans, which is what they do, I mean, you need really high-quality risk management, and starting with the credit analysis. But it's fair to say that a lot, because they tend to be small, they didn't have good credit analysis to start with, so they're making loans not really understanding the type of risks they were taking, and even after they made the loans, they didn't have good risk management systems, and so when risk came to bite them, they weren't ready for it. But you're right about the people and the people thing here. Let's see, where's these? Well, Alan Hubbard, he's there a few times. Like Alan Hubbard is here and here. Yeah. Oh, yeah. There's one there. Yeah. So, and some of these others, like this guy, Mark Hodgkin, and so on. Oh, there's Ruth Richardson. She used to be Minister of Finance. That's a real recommendation. Yeah. Sometimes, when you look at it, it's more than just bad management. I mean, there's in fact, some of these people have been in court, and so there was criminal negligence and that sort of stuff. I don't think she did, actually. But anyway, yeah, because a lot of people, when you think of the total amount of money that was at stake, it's about just over $9 billion, and a lot of people who invested in those things, they did lose lots, and then of course some cases they lost all the money they invested, because they were offering high interest rates relative to the banks, and most people, like Nathan said yesterday, if you're going to make investment, you need to understand the risks, and a lot of people simply did not understand the risks that were associated with these things, made investments that were unwise, and paid for it. Okay. Yeah, if you're convicted for there's a range of different things. If you're convicted, then you can't become a director of a company. Even if you're you're personally bankrupt, then you can't become a director of a company. And some of these convictions for some of these things, you would never be able to be a director of a company again. So hopefully, if they go down that path and they prosecute and get a conviction, hopefully, that'll keep those people out. But, criminals grow up, new ones coming through, all the time. That's the way it goes. Okay. Anyway. So how do they differ from a bank, a credit union, or a building society? What makes them different? Oh, right. Okay. So roll along. So the thing that it really makes them different is that they're not authorized deposit-taking institutions. Okay, so they don't take deposits. You can't go into a finance company and open an account with them in the same way that you can go into a credit union or a building society or bank. And so what that means really for them is, if you think about the other ones having a prudential regulator, the finance companies and in Australia do not have a prudential regulator. Okay, so there's no one making sure that they're not doing too much risk. And in New Zealand, there was this comprehensive law of 2007 that we've talked about, and that's at that point when they were put under the Reserve Bank of New Zealand. So that they do have sort of a bit of a prudential regulator now, but it's taken the Reserve Bank a number of years to start to develop regulation for these types of institutions. So because they don't have deposits, the question is where on earth they get their money from. And they can often borrow from a bank. In fact, some of the finance companies are actually owned by banks. And in New Zealand, they often had these things, these retail debentures, these, what do they call them? First-ranking secured debentures, which turned out to be pretty rubbishy. But anyway, so they don't take deposits. And so they tend to get wholesale funding. In New Zealand, they do tend to try to get retail funding through these debentures, but they don't have a bunch of deposits. And so they tend to be rather much more long-term in terms of the amount of funds they get. But they're not all bad. UDC, which is one of our major ones, it does have a AA credit rating, and that's been around for a very long time, very well run. I'm not sure if it's ANZ was actually at one point going to sell it. Don't know if they have yet, but they're one of the good ones that have been around many, many years, and they do a good job. Now, there were a group of these things we call the captive sales finance companies, like these ones, Ford, BMW, Holden Financial Services. No prizes for guessing what they financed. They essentially financed the product of their parent company. This one here, GE, was initially a captive finance company, financing people into the products made by General Electric, but it's become basically a diversified finance company on its own, and it has been in operation in this part of the world, originally from the United States. So, what are the main assets? Yeah. Oh, do you have a question? Actually, I don't know what they do.
They always seem to be bragging about financing tractors and helicopters and productive assets.
Yeah.
So a finance company like that, let's say that it was heavily reliant on the agricultural-based industry, would that make them more expensive, especially with fluctuations and stuff like dairy prices and meat and all that? Does that make UDC more vulnerable than it might suggest, in part?
The thing is that the very nature of the lending is higher risk. If you think, you take the example of a tractor, that's as soon as it rolls off the lot, it's depreciating, and it's a depreciating asset. So if they have a default on a tractor, they're going to probably tend to lose much more money than if someone is making a loan on a house. And so they are high risk. The thing with UDC is it has been in existence for, I think over 80 years, is that it does do its credit analysis very well at the start, and it's done its risk management well. And so if you look at their interest rates relative to a bank, they're definitely higher, but they're not a lot higher. And I think it's around the quality of the job they do. There's no question that if you're financing tractors, that's higher risk than financing houses. Okay, any other questions? Okay. So they have the same type of loans as anyone else, but they tend to be these high-risk ones. When you think about motor vehicle loans and these other things, the point I just made before about the type of asset that's being bought is depreciating. For example, you buy a motor vehicle of some sort for yourself. As soon as you drive it off the lot, you've lost a few $1,000s. You buy a washing machine, you buy a refrigerator, it depreciates. And so these tend to be higher risk. And if you think about the real estate lending that they're doing, often if you go to a finance company for real estate lending, you tend to end up with a second mortgage, which is, again, that's a higher risk type of mortgage than a first mortgage. And all this stuff here, the business credit, these things here, like, for example, these floor plan ones, what they're doing is financing an inventory. Like, for example, if a shop is selling, whiteware, washing machines, fridges, freezers, stoves, that sort of stuff. Again, while they're financing into them, they are depreciating assets. Retail paper, sometimes, not sometimes, many times they'll actually make consumer loans. So if you wanted to go and buy a motor vehicle, often the dealer there can actually get you to sign up for finance, and that will come from a finance company. And because it's higher risk, they do charge significantly higher interest rates than you would get, say, from a bank. These ones here, they're all high risk. This is an interesting one, a purchase of accounts receivable. Sometimes, when people are slow to pay and a company wants the funds straight off, and they need cash, they'll actually sell their accounts receivable. Sometimes, if they get a big batch of bad debts, they'll sell them to a finance company. In fact, one of the big sales I knew about some years ago now was Telstra, that's an Australian telecoms company, sold $300 million worth of bad debts to a finance company at the rate of 6 cents on the dollar. And then the finance company would go about trying to recover that. So, again, if you do this, these are accounts receivable, they're high risk. The assets that are backing them, if there's any security at all, are depreciating assets. So what type of securities do companies issue to obtain their funds? What do they do? All right, roll on. So typically, this is where they get them from: bank debt, so they can borrow directly from the bank. If they have a high enough credit rating, like UDC does, maybe some commercial paper, for things like BMW and Ford and Holden finance companies, they can get money directly from their parent companies. Some of them will issue long-term debt. Typically, those debentures can be up to 5 years. And the thing is, when you look at how much it's costing them, this tends to be higher cost of funds than, for example, for a bank. If you look at the cost of funds for a finance company relative to a bank, then the cost of funds for a finance company tend to be higher. And so, between that and the fact that they're making higher risk loans, the interest rates on these loans can be significantly higher. A number of them are, well, not many in New Zealand do this, although there's a small number in New Zealand who've done the securitization. And basically, if you think about what happens there, if they make loans and they're holding them on their books and they want to raise funds, they can actually take those loans, turn them into securities, and sell them, and that raises further funds for them to go and make more loans. So it's a source of funds for them. And the other developments we've seen, movement toward business, second mortgage lending, again, leasing, where there's tax advantages to do that, you'll see finance companies involved. Now here's another one. I always think this is a bit hairy, but people do this. I don't know why they do this. Is that if you say you bought your home 20 years ago and it's gone up way up in value, what they're trying to say is, oh, look at all that value you have in your home. Why don't you just pull some money out and go for a holiday overseas, and blow it. And so what they're doing is essentially, providing people with access to the equity in their houses to basically go and consume things today. I always think that's pretty, if you were in the position that you had your home freehold or close to it, that this would be a silly thing to do. But they get plenty of people to do this. Small ones, they've gone out of business. We just had a list of 67 that went there. Small ones have a trouble with their risk management simply because they don't have much staff, and their credit analysis, again, poor credit analysis, basically a lack of staff. And so they've gone out of business. So there's the last little bit of most of the chapters relevant. Skip the legislation stuff. So if you want to ask any questions, I'll be around for a while. Otherwise, we'll start a new topic tomorrow.